evaluate strength of a balance sheet. So as I said, there are many things that you can do. Number one, look at the figure of reserves and surplus. रिजर्व्स एंड सरप्लस रिमेंबर इज अ प्राइम इंडिकेटर. जिस कंपनी का रिजर्व्स एंड सरप्लस का फिगर जितना ज़्यादा होगा वो कंपनी उतनी ज़्यादा अच्छी है, ये आप आंख बंद करके मान सकते हैं. और अगर आप पिछली कुछ सालों का ट्रेंड देखें और अगर आप देखें कि ये जो रिजर्व्स एंड सरप्लस का फिगर है हर साल बढ़ रहा है, दैट मीन्स दिस कंपनी इज ऑन अ ग्रोथ पाथ, दैट इज़ फॉर श्योर. अगर एक कंपनी का रिजर्व्स एंड सरप्लस का फिगर नेगेटिव है या कम है या कम होते जा रहा है, that means this company is in trouble, and this company can be only an opportunity for you provided you are trying to be in the profession of turning around the businesses, because for you then it becomes a very good opportunity. Otherwise, if you are only looking from the pure investment point of view, don't touch it. Number two, what you can look at is the debt equity ratio. How do you calculate the debt equity ratio? So debt equity is debt. Debt means long-term borrowing. Debt means long-term borrowing. Divided it by the equity, and I'm sure all of you would remember, equity would also mean shareholders fund. Equity will also mean shareholders fund. So another thing, another factor that would help you to evaluate a balance sheet is by looking at the debt equity ratio. जितना ये रेशियो कम होगा, lesser the better. But remember, it is not a permanent rule, but general, lesser the better. And why lesser the better? Because जितना आपका debt कम होगा, उतनी आपकी interest की liability कम होगी, और जितनी आपका debt कम होगा, उतनी आपकी repayment obligation कम होगा. And that means there is so much less pressure on your EBITDA. So if your EBITDA is good, if your EBITDA is sizable, you can afford to make fresh investment by borrowing more money. Because when you are borrowing more money and assuming that you are going for an expansion, that means you will be generating even more EBITDA, and that means you will be very easily be able to take care of your interest and your debt. And so that is how debt equity ratio is another factor to find out whether a balance sheet is good or not good. Third is total asset to equity ratio. So take the total assets and divided it by the equity. Equity means the same thing, shareholders fund or equity or net worth or book value. So total assets divided by equity is another ratio that gives you an idea as to how the balance sheet is. So this ratio again, lesser the better. So jitna aapka assets are funded more by equity, it is so much better. It is so much better. If this ratio is very high, your total assets divided by equity is very high, that means your assets are funded more by debt and less by equity. That is not a good sign. In case if your EBITDA is not very strong, if your EBITDA is very strong, and if this, in that case, if this ratio is high, it's not an issue at all. The fourth is current ratio. How do you calculate the current ratio? I am sure you all remember the current asset that we discussed, and you also remember the current liabilities that we discussed. So this is how you calculate your current ratio. CR is equal to current assets divided by current liabilities. So let's say there's a company, and this company's current assets are 200 and this company's current liabilities are 100. That means what is the current ratio? The current ratio is 2. Current ratio is 2. Okay. So now I would like to ask you a question before we move forward to the next point. All of you,